On December 12, 1980, two coworkers stand in the same break room, staring at the same newspaper. Apple Computer has just gone public. Maya is 29. Daniel is 31. They both like the story. Two guys in a garage, a strange little computer company, a market suddenly obsessed with technology. So they each do something that feels bold at the time. They invest about $1,000. At Apple's IPO price of $22 a share, that buys 45 shares, with a little cash left over. Same company, same day, same starting line. But 5 years later, Daniel looks at Apple and sees chaos. Steve Jobs is forced out in 1985. IBM is dominating business computers. Apple looks expensive, emotional, and uncertain. So Daniel sells. Maya does nothing. Not because she knows the future, not because she's a genius. She just never touches it. No trading, no trimming, no taking profits, no panic selling. So what happens if you invested in Apple at its IPO and never touched it? Here's the mechanism most people miss. When we hear Apple IPO, we imagine one clean line from garage startup to iPhone empire. But that is not what shareholders lived through. Apple went public in 1980 at a valuation of about $1.8 billion. It raised roughly $97 million in the offering, and it instantly created hundreds of paper millionaires. But your 45 shares did not stay 45 shares. Apple split its stock 5 times. A 2-for-1 split in 1987, another 2-for-1 in 2000, another 2-for-1 in 2005, a 7-for-1 split in 2014, and a 4-for-1 split in 2020. Multiply those together, and every original IPO share became 224 shares. So Maya's 45 IPO shares eventually became 10,080 shares. That's the quiet magic of splits. They don't make you richer by themselves. They just divide the same ownership into more pieces. The real question is whether the business underneath those pieces grows. And with Apple, that answer took a very, very long time to become obvious. Daniel sells in 1985. From his point of view, this is not irrational. Apple had been public for almost 5 years. The Macintosh launched in 1984 with the famous Super Bowl ad, but sales were slower than hoped. The Apple II was still important, but the company's identity was messy. Internal battles were constant. And then, in September 1985, Steve Jobs left the company he co-founded. Imagine owning the stock then. You did not know there would be an iPod. You did not know there would be an iPhone. You did not know Apple would become one of the most valuable companies in history. You knew the founder was gone. Daniel's $1,000 had grown. Apple's split-adjusted stock price by late 1985 was roughly around 25 to 30 cents, compared with a split-adjusted IPO price of about 10 cents. So Daniel might walk away with about $2,700 before taxes. That feels like a win. He nearly triples his money in 5 years. Most people would brag about that. Then Daniel makes a very reasonable second choice. He puts that money into a broad US stock market fund and leaves it alone. From the end of 1985 to the mid-2020s, the S&P 500 rises dramatically. The index itself goes from around 210 to well over 5,000. With dividends reinvested, the total return is even higher, roughly 70 to 80 times over that stretch, depending on the exact dates. So Daniel's $2,700 can become something like $190,000 to $215,000. That is a fantastic result. He did not waste the money. He did not gamble it away. He made a profit, diversified, and participated in nearly 4 decades of American capitalism. By almost any normal standard, Daniel did well. Maya, meanwhile, looks like she did nothing. But doing nothing is about to become the hardest part of the story, because Apple did not go straight up. In the 1990s, Apple nearly died. By 1997, the company was losing money, its product line was confusing, and Microsoft had won the personal computer war. Apple's market share was tiny. Its cash position was worrying. Business magazines openly questioned whether the company could survive. That same year, Apple took a $150 million investment from Microsoft. Yes, Microsoft, the arch rival. That investment was announced at Macworld in 1997, and the crowd booed when Bill Gates appeared on the giant screen. For Maya, this is the plot twist. She is not sitting on a calm, obvious winner. She is sitting on a stock that has already gone through brutal cycles, leadership drama, and years of disappointment. Apple stock had suffered multiple massive drawdowns. In the early 1980s, it fell sharply after its IPO excitement faded. In the 1990s, it collapsed again as investors questioned its survival. Later, even after Apple became successful, it still dropped more than 50% during the 2008 financial crisis. And in 2000, after the dot-com bubble burst, Apple shares were crushed along with the rest of tech. This is where the psychology matters. A 50% loss does not feel like a spreadsheet. It feels like a mistake. An 80% drop does not feel like volatility. It feels like the market telling you were wrong. Studies from firms like Dalbar have repeatedly found that individual investors often underperform the funds they own, not because the funds fail, but because people buy after excitement and sell after fear. Maya's edge is not prediction, it is survival. She survives boredom, she survives embarrassment, she survives the feeling that she should do something. And then, Apple changes. The iMac arrives in 1998. The iPod arrives in 2001. The iTunes Store launches in 2003. The iPhone arrives in 2007. The App Store opens in 2008. The iPad follows in 2010. Apple stops being just a computer company. It becomes a consumer ecosystem. Now Maya's forgotten 10,080 shares start to look unreal. Apple's market value crosses $1 trillion in 2018, then $2 trillion in 2020, then $3 trillion in 2022. By the mid-2020s, Apple stock trades around the high hundreds of dollars per share, depending on the month. Use a rough price of $190 a share. Maya's 10,080 shares are worth about $1.9 million. And that's before counting dividends. Apple paid dividends in its early public years, stopped them in the 1990s, then restarted them in 2012. From 2012 onward, those quarterly dividends added tens of thousands of dollars more for someone holding 10,080 shares. Even without reinvesting. So the rough comparison looks like this. Daniel sells in 1985, invests broadly, and ends up around $200,000. Maya never touches Apple and ends up around $1.9 million, plus dividends. Both made one decision, both were patient, but one stayed with a single extraordinary company through every terrifying chapter. Here's the uncomfortable takeaway. The lesson is not put all your money into one stock and wait 45 years. That would be the wrong lesson. For every Apple, there are companies that looked promising and vanished. In 1980, nobody could know Apple would survive Microsoft, reinvent music, redefine phones, and build a services business with hundreds of millions of paying users. The real lesson is about asymmetry. When you buy a stock, the most you can lose is 100%. But in rare cases, the upside can be 10 times, 100 times, even more. The hard part is that those rare winners often spend years looking like mistakes before they look inevitable. So the question is not just, would you have bought Apple at the IPO? The harder question is, would you have held after Steve Jobs left? Would you have held when Microsoft looked unbeatable? Would you have held when Apple needed help from its biggest rival? Would you have held through crashes, recessions, product failures, and headlines predicting the end? Because the fortune did not come from seeing the future in 1980. It came from not interrupting compounding once it had the chance to work. And that may be the most difficult investment skill of all. So what if you invested in Apple, an IPO, and never touched it? You would have owned one of the greatest compounding stories in market history, but only if you survived decades of doubt, fear, and reasons to sell. The real lesson is that extraordinary returns often require extraordinary patience. If you found this useful, subscribe to What If Finance. New video every week.